Hi everyone, I'm Saul with My Fi Journey, looking to be financially independent by December of 2026. And in today's video, we are talking Roth conversion ladders, what they are, why you should think about them, especially if you're planning on becoming financially independent or retiring before your full retirement age. So let's get to it. I'm gonna need you to come in on Saturday. Show me the money. And welcome back to My Fi Journey. Today we are talking traditional to Roth conversion ladders. Now in my previous video we talked about what the difference were between a traditional IRA and a Roth IRA, so I'm going to put a link to that video in the notes of this video just so that you can go back and reference it. So today we're basically talking what is the process, what does it mean, why should I even consider making a traditional to Roth conversion, and then what that whole term of conversion ladder actually means. So what is a traditional to Roth conversion? Well, what happens is you're moving money out of your traditional account, traditional IRA account, and you're putting that into a Roth IRA account. Once you do that, you are paying taxes on the amount that you convert. So if you take out 100 grand from your traditional IRA to move to your Roth IRA, you will be paying taxes against those $100,000. Now, once you do that, the amount of tax that you will pay against that, say, $100,000 is going to depend on what taxable bracket you fall in for the year when you made that conversion. To make it a little bit easier, let's go ahead and take a look at the example that I prepared for you guys. So in this graph, this rectangle has on the left side has the amount of money, the upper limits of the taxable brackets that you see there. So 9,950 is the upper limit for the 10% bracket. 40,525 is the upper limit for the 12% bracket, etc. That is for single filers. On the right side, you see the same numbers that make up those percentages for married filing jointly type couples. So, if you are in the 12%, the upper band of that bracket is $81,050. Anything above that will fall into the 22% bracket. So for this example, because I like to make the numbers just work easier, let's assume that you already retired and that you have some passive income coming in, whether it's from rental income, dividend investment income, etc., and you are generating approximately $100,000 per year. What that means is if you are, in this case, the example is for a married filing jointly couple, you fall in the 22% bracket. However, you still have up to $72,750 difference between that $100,000 that you are making in, and that is taxable income, right? So this is after your standard deduction or, whatever type of deductions you're getting. You still have $72,750 left before you go over to the next bracket. Now again, this doesn't mean that you're going to be paying 24% of everything if you do go over. It's just you would pay 24% of the amount that goes over. So say you decide to transfer, for this example, let's say you decide to transfer $80,000 to a Roth IRA. $72,750 that you transfer will be taxed at a 22% bracket, and the remaining $7,250 are going to be taxed at the 24%. So in this example, I would choose just to move to $72,750 because that's not going to put me above any more tax. That's 22%. It's still less tax than what I would do if I make the move while I'm still working, generating more income than just the $100,000 as a married couple. So it makes sense. So that means you've got, if you don't want to go over to the next bracket, you have up to $72,750 that you can go ahead and move to a Roth IRA. And the nice thing about the Roth IRA is you never pay taxes on the amount that you put in or on the amount that grows within that investment at any time once you take that retirement money out. Now, a key difference though, when you do a conversion, currently the rules are that you are not allowed to take money out, any contributions out, until at least 5 years from the date that you did the transfer into the Roth IRA from a traditional IRA. Now, I believe this rule basically becomes null if you turn 59 and a half, but please check your tax advisor to make sure that that is the case. Right now, for me, because I'm planning on doing this when I retire, but I'm going to be retiring early, I will have to wait at least 5 years before I can take my contributions. Any growth you cannot take out until you turn 59 and a half. So that's basically a Roth conversion. Now, if you want to make a Roth conversion ladder, you basically just go through that process every year. You take a look at how much, what tax bracket you're falling in. And if you don't want to go over, which is the whole point of making a conversion after you retire, is that you are going to be in a lower tax bracket. So you pay less taxes when you do the conversion. Now, why would you even want to do a conversion to begin with, right? So you have seen some of my videos where I explain to you, the rule of 72, is basically if you divide 72 by the interest rate or the yield or the expected growth percentage, that's the number of years that it's going to take to double the amount you have invested. So let's say you have $100,000 in a traditional IRA and it's at 8%, right? So in 7 years or 9 years, that amount is going to grow to $200,000, and then 18 years is going to go to $400,000, right? Every 9 years it's going to double. Every time it doubles, you are generating more money, obviously. But then when it comes to the required minimum distributions in a traditional IRA, you're going to have to take that full amount whether you want it or not, and that may put you in a higher taxable bracket. So that means you will be ending up paying more taxes once you are required to take that amount off. By doing this conversion, at a moment when you know you're going to be at a lower tax bracket, you are saving on taxes right now, plus any money that you put in that Roth IRA, you're not going to be paid taxes ever, and you are not required to get any required minimum distribution out of a Roth IRA account either. So it's a win-win. And like I explained, I don't know if you've seen my interview with Bigger Pockets Money, my plan is I'm going to be converting as much money as I can before the age of 59 and a half, so that I can put that in a Roth IRA. I'm going to be using money from my taxable account at that time. But basically my plan is, let's say I'm going to be 70 years old. I'm not going to have any money in a tax deferred retirement account. So I'm not going to have any money in a traditional IRA account by that time, or a 401k account. So basically what I'm planning on doing is I'm planning on not having the need to take a required minimum distribution. All of my money is going to be coming in from my brokerage account, my investments on a taxable brokerage account, or from a Roth IRA at that moment. So I'm going to be saving taxes by doing that. So that's my plan. Let me know what you think about it. Let me know your comments. Maybe something I didn't think about that might make sense for anybody trying to retire early. And again, if you like this video, give it a thumbs up. That's going to help other viewers get this video in their feed. And also don't forget to subscribe to my channel so that anytime I bring in a new video, you get alerted and are able to check it out. Thank you, and until next time.